IBM is down 5% year to date and offers a yield just below 5%. But is it a buy now? We're going to find out in today's episode. We're going to look at the historical prices of international business machines. We're going to jump in and look at their income statement, see how their revenues progressed year on year and their bottom line net income. We're going to jump into their balance sheet, look at their total cash versus total debt. We're going to jump into their dividend safety. How safe is their dividend? We're going to look at some important financial metrics, and we're going to look at the stock valuation model. What is the intrinsic value and what is our acceptable buy given our margin of safety? So it is down 5% year to date, and it is in the middle of that 52-week range. It does offer a very nice starting yield of just below 5%. And for those who have held the stock for the last 10 years, well, not so great. Negative 28% return. So what we want to understand is, can we be buying this at a discount, and is there room for future growth and future dividend increases, making our yield on cost very, very nice? So revenues, typically we like to see increases of 3 to 7% year on year. December 2018, they reported revenues of just under 80 billion. And in December 2022, 5 years later, this has dropped dramatically to 60 billion. So whilst we're looking for 3 to 7% increases year on year, what we can in fact see is December 2018, it did drop to December 2019. But from that period on, it has seen some stability and a little bit of growth. So we're going to take a look in our metrics and understand why. Now, the bottom line, the net income, what we can see here is it's reported 8.7 billion in December 2018 and a very large drop in December 22 of 1.6 billion. So it has in fact dropped over the last 5 years quite significantly. Now, these are all red flag indicators, but it doesn't mean it is uninvestable. And if we can find out why, understand the reasons, and see if we can take advantage of the current share price. But let's take a look further. Now, cash reported in December 2018, just under 12 billion, and in their latest quarterly report, just over 17 billion. So there has been some nice growth with their cash over the last 5 years. And now taking a look at that long-term, total debt, what we can see is their total debt has gone from 45.8 billion in December 2018 to just under 62 billion in their latest quarterly report. So it has increased, and we will now look at our financial metrics and understand why essentially this is happening, and to understand if they can continue to pay their dividend, give some nice increases, and pay off their interest and debt. So safety score of 65, market cap with 121 billion, making it a mega cap. Now, key metrics, what we can see here, they have paid a dividend for 28 years without a reduction. We can also see in the latest recession, 07-09, they increased the dividend, which is positive if you believe we are heading into one. Recession sales, whilst it was negative 9%, this was the average growth during this period. And we can see here, again, whilst it had negative 28% return during the last recession, it did beat the S&P's negative 55%. Dividends, so they are actually a dividend aristocrat, paying dividends consecutively for 25 years or more, makes it have that title. Latest increase, 0.6, which is very poor. However, the last 20 years, the dividend has compounded at 13%. Whilst that is very nice to see, that in combination essentially with the share price drop over the last 10 years is a red flag indicator. As always, for those that are new, we want 4% or more in our dividend increases, as the US inflation rate over the last 40 years was 4%. So if you're getting less, you're taking a purchasing power loss and you are losing, essentially taking a pay cut. So 4% increase in your dividends, in your salaries or other income producing assets. Now, dividend yield theory states that a company is undervalued when that current yield is sitting above the 5-year average. So currently, based on this theory, it looks to be reasonably valued. Forward PE, slightly higher than the 5-year average, so you could argue a slight overvaluation based on the forward PE. But what we can see by the sector PE comparison, it is significantly lower. And 52-week price range, bang on in the middle. Again, if it was at the 52-week low, it wouldn't mean undervaluation. If it was at the 52-week high, it wouldn't mean overvaluation. Do go check out my pinned YouTube video if you want to understand my 7 golden dividend metrics and how I analyze stocks. One of them is, in fact, that we look for below 60% in our payouts, due to the fact that that's a threshold for me that I like to see so that I have confidence in management paying out those double-digit dividend increases we like to see. Typically, we don't look at the earnings payout as it's susceptible to manipulation through management, through their accounting, but they essentially mirror a very similar story with this company. We like to see below 60% on both. Over the last few years, it has increased. It's been below 50% or thereabouts over the last 8 years, between 13 and 20. But 2021, 59%, 2022, 70%. It is looking to come down. Predicted the free cash flow in 2023 at 57%. So that is more positive. Again, earnings per share, I do prefer to look at the free cash flow per share. So the free cash flow per share, $12.20 in 2013. It has essentially dropped. And this is why I like to look at least 10 years worth of data to give a better sense of a business and the overview. 2022, $9.38. So it has dropped. But having said that, 2023, they are expecting to pick that back up to $11.70. Still not the greatest. A lot of the companies we like to invest in do have an upwards trajectory with a very nice increase year on year. So again, not the greatest that we would want from a company. Now, this in itself could just turn off investors completely. Purely the fact that, as we said, we like 3 to 7% sales year on year. What we can in fact see here is the complete opposite, and it looks more like 3 to 7% in negative growth year on year. Now, 21 and 22 has seen room for growth, but this is a worry, and I would look to see why management believe they can turn this around. December 2013, 98 billion worth of sales reported. 2022, 60 billion. Essentially, when you're looking at companies, you want it the other way around. So again, a red flag indicator so far. Shares outstanding. We love it when companies return excess cash to our shareholders. What we can see here is they have been buying back shares. December 2013, 1.1 billion shares outstanding. 2022, 912 million. So it is decreasing, however, at a very slow rate, and not really much that I would say about this in particular. Again, another one of my 7 golden dividend metrics, ROIC. I like to see at least 10% plus, as it means management are effectively allocating their capital. Have been a few years where it's slipped above there, but December 22, 10%. Now, operating margins, 12% plus. While they have been doing that for the majority of the years, it has been dropping from December 2019. So it is something I would keep an eye on, because if we do see the operating margins start to slip, this could be very, very bad news. So free cash flow margin, on the other hand, however, does look positive with 5% across the board plus year on year, and some years of very nice percentages. So positive with that respect. Net debt to earnings before interest, tax, depreciation, amortization, something I flagged on the balance sheet review. Whilst we do like to see this below 3, it has started to creep up from 2018 onwards. So whilst it is projected to be below the average for this period at 2.14 in 2013, something to keep an eye on, because this, in combined with the fact of the other metrics, will hamper that dividend and that safety. Net debt to capital essentially showing that whilst we like below 40%, it looks to be around 60% in terms of the percentage of the company's financing from debt as opposed to capital. So a mixed bag there so far. As always, if you're enjoying the content, do hit that like button if value is being provided. Do subscribe for more content. If you want to grab a copy of the stock valuation model, do check the pinned description and grab a copy to run your own company through these metrics. Okay, so let's jump in. And as always, if you do want to join us on Patreon, do check that too. So IBM EPS 225. Growth rate as expected by analyst estimates at 37, with the current yield on AAA corporate bond. Intrinsic value sitting at $91, so even lower than that 52-week low, so signs of overvaluation currently. Companies in a similar sector and size, we have Oracle and Accenture. We have the stock price earnings per share with our PE multiples. We do the average multiplied by the earnings per share, gives a stock price based on this model at $72.76. Again, signs of overvaluation. We've put the dividends in year on year, and we can see a very low, below inflation growth rate at 1%. What we can see here, we've predicted 2% forward, which could be a bit more on the generous side. Gives a DDM price of $112, right there on that 52-week low. Finally, we have the discounted cash flow with our free cash flows year on year. The growth rate year on year with an average at 3.7%. We've gone with a growth rate expected by analyst estimates at 3.5%. Using our discount rate, we get the present value of these future free cash flows and terminal value, which we add together with the cash and equivalents, subtract total debt, get to our equity value, which we divide by the shares outstanding, to come for a DCF price of $157.15, right there at that 52-week high. So, few different methods we've just run through, and the intrinsic value is essentially the average of these four. As always, do hit the like button if you are enjoying the content and value has been provided, and do subscribe for more content. So the intrinsic value comes to just under $109. Now, before I look at our acceptable buy price, Wall Street are forecasting to have some essential uplift to that current share price. Not much, just under 10% at $146. Now, for me, these are based on my estimates. Likewise, if you do want to grab a copy and run your own estimates and judgments through, a margin of safety, typically, I would be looking at 10% for a company with a wide moat, nice financial metrics, and nice forward guidance, which this company doesn't have. So I would be looking at 20%. But if you did want 10%, your acceptable buy price would be $98. And we can see that is below that 52-week high. Me personally, I'd be looking at 20%, which is around $87. And we can see that is well below that 52-week low, which in all honesty means I will not be entering into this and buying this within my portfolio. However, do let me know your thoughts in the comments. Do let me know if you're a shareholder, if you're considering buying or selling. And as always, take care and catch you on the next episode.